Chris, I'm just going to cut to the chase. Is there a next NYCB? We had SVB. Now we've got the follies here where the former Secretary of Treasury wades in to save the day. Do you just assume there's another one out there?
Yes. And the reason I say that, Tom, is that the changes that have occurred in the usage of certain types of real estate, commercial buildings, multifamily buildings, and then politics, rent control legislation in New York was a fiasco. And now one of the last great progressives in Washington, Marty Gruenberg, has decided to stick the U.S. banking industry with the cost. I don't think he intends to ever sell the joint ventures that control the rent-stabilized assets from Signature Bank.
My amateur take on this, including reading your definitive one volume on American finance, is that these are marketing concepts at SVB, at NYCB, at all. They're like marketing plans with growthiness in them that go amok. Is that accurate?
It is, Tom, and I also think it was a function of the time. In other words, you had muted credit costs, you had heavily managed markets, care of the FOMC. So bankers had an easy time, and certain business models actually grew, like First Republic. I mean, my God, I think the only way they made money was selling loans. The rest of the business model didn't, particularly work. And they were a client of JP Morgan in the mortgage space. So I think you're dead on. There were a lot of models that grew over the last 10 years, really since 2008, that don't work now. And particularly the change in the valuation of urban commercial and urban multifamily real estate is episodic. I rated many of the banks in New York, Tom, when I was at Kroll. These portfolios hadn't seen any appreciable credit loss in 75, 100 years. And they were always fully let. These buildings today we're talking about are fully let. They cash flow, but you can't sell them. The value's been cut in half.
And Paul, I see this every single transaction I review as an amateur. Many of these busted properties are like 92, 97, 98% rented.
Chris, how does the average investor identify maybe where the next landmine can be? I guess a lot of people are concerned about commercial real estate. Nobody had on their bingo card rent-controlled apartments in New York City.
No, and I don't think we fully, including myself, understood how prevalent this problem was. When New York Community Bank bought Signature, they said, no, we don't want the rent-stabilized stuff. You keep that. And the FDIC did. But we didn't realize they also had that. They've since fessed up, and they're probably going to drop a significant restatement when they finally file for the end of the year. And I think a lot of investors are quite angry because they feel like they were not told the truth. But let's be fair. All of these New York City banks haven't had to worry about credit in 50 plus years. That's why they allowed Joe Ficalora at New York Community Bank to run that bank with a lot of hot money, brokered deposits, right? He had no credit losses. So it worked. It doesn't work now. I think that $1 billion from Steve Mnuchin is not enough. I think they should create a bad bank.
Yeah, Chris, help us there.
You need 10. We need 10, Tom.
Yeah, well, just, we don't want numbers on a Thursday, but, I looked at, what was it, $1 billion? I said, that's like chump change. I mean,
in this context, yes, you have a $40 billion, more or less, multifamily book. What's a reasonable haircut on that, Tom?
Yeah.
Okay. 25 cents to start.
Yeah.
And we work back from that. But they have time. Remember, again, these are cash flowing assets that are now impaired because of political actions in New York. So we have time. It's not like people don't want to live there, but over time, the value of these assets is going to deteriorate. And that's why I said I don't think FDIC Chairman Gruenberg has any intention of selling those properties. He'll leave that for the Republicans to deal with.
So, Chris, if we step back, is there reason to believe that there are systemic risk in the regional banking system in this country? Or again, is it just kind of these one-off situations?
It's chopped salad. The only way you could do the work is to go pull all the loan-level data from TREP, which is very expensive, and do the work on who owns the mortgage and who bought the participation in the mortgage. There's a lot of risk that's been spread out through participations. And I would remind you that the FDIC has the power to repudiate participations in the context of the receivership. I've worked for several receivers myself, and that's the first thing they ask you when they hire. So I would tell you yes,
Right.
Paul. The answer to your question is, but it's institution by institution. And again, they have time. Banks have the ability to slow walk this stuff for years
Right.
if they have liquidity,
Okay,
if they
so-
can finance the asset. But they may end up as the owner. We may wipe out that 50 cents of equity, quote unquote, on top, right? And the bank ends up owning the property at 50 cents on the dollar. Now the question is, can they work with
that's
it?
my last question, and I think it's really important, Chris. I mean, with great respect for people that are taking a lot of losses on this, and thank you so much for on YouTube live chat saying, "Hey Tom, wasn't NYCB a sponsor of yours?" Full disclosure, folks, a long time ago, NYCB was really supportive of our conversation. Chris Whalen, is a general statement in your world, rates have moved, there's going to be a loss. But the moment the loss is taken and new money comes in, it's a whole new world after all. Is it going to be morning in America for banking in what, Paul, 2 years?
Yeah.
Something like that. Is that where we're at?
Only if we see short-term rates fall a bit. We need to get Fed funds down into the kind of mid to low fours. I'm not sure the long end is going to follow in a traditional sense. I think it's different this time. And the Treasury's financing costs, which they've got to put on the long end. They can't just do T-bills anymore, Tom.
Okay.
That's going to be the story.